Ever wondered what really happens when you invest your money into the stock market? Is it just gambling, or is there a system behind the chaos? Today, let's follow the journey of a single $100 bill and discover how wealth can be built step by step. Hey everyone, welcome back to the EduTech channel, your go-to place for future-proof learning. Companies issue shares, small pieces of ownership, and investors buy those shares, becoming part owners. In return, investors hope the company grows and their shares become more valuable. Businesses need money to grow, to hire people, build new products, open new locations. Instead of borrowing huge amounts from banks, many companies sell part of their business to the public. This first sale is called an IPO, an initial public offering. It's like a business opening its doors to the world and saying, "Want to join our journey? Buy a piece of us." After the IPO, investors trade shares with each other every day. Millions of shares change hands, not from businesses, but from one investor to another. This buying and selling is what moves stock prices minute by minute. Sometimes it's excitement, sometimes it's fear. Millions of trades every day push prices up or pull them down. It's all about supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price drops. News, earnings, product launches, even global events all affect how people feel about stocks. And when emotions shift, prices can swing wildly, even if the business hasn't changed. The stock market is a living, breathing reflection of human emotions: hope, fear, excitement, and doubt. Every surge and crash tells a story of how people feel, not just what companies do. In the short term, stock prices are wild and unpredictable. They react to every rumor, every headline. It's like a roller coaster, thrilling but not always logical. But over the long term, stock prices generally follow the real success of businesses: growing profits, expanding customers, bigger impacts. That's where real, lasting value comes from. Let's put our $100 to work. Instead of betting it all on one company, we spread it across different industries: tech, healthcare, energy, and more, to balance risk and opportunity. As companies grow, launch new products, and earn more profits, our small ownership stake grows in value too. It's like riding along with their success. Some companies also pay dividends, small cash payments to shareholders. It's like a thank you gift for investing, and over time, those little gifts can really add up. Reinvesting those dividends means even faster growth over time. Instead of spending them, we use them to buy more shares. That's the power of compounding in action. When you earn profits and then earn profits on top of your profits, that's called compounding. It's how small investments can turn into serious wealth over decades. Not every company succeeds. Some fail, some stocks fall sharply. That's why smart investors diversify and stay patient. It's not about being perfect. It's about being prepared. The stock market has survived wars, recessions, crises, and through it all, it has continued to grow over the long run. That's why time in the market beats timing the market. Our patient $100 through smart investing could double, triple, or even quadruple in value over 20 to 30 years, and all it had to do was stay invested. It's not magic. It's time, patience, and letting businesses work for you. You don't need to predict the next big thing. You just need to stay consistent and let compounding do the heavy lifting. Thanks for joining us. If you enjoyed this journey, don't forget to like, subscribe, and hit the bell for more lessons from the EduTech channel.